All right, we are, as you can see, we are one team member down due to illness, but we are very excited to be here. So we're here today to talk about Alibaba, of course, ticker BABA. We have a price target of 120, which represents 39% upside on the current price of $87. So to understand Alibaba, you have to understand three things. One, founder Jack Ma, very unique personality. You have to understand the immense demographics involved in China and China's e-commerce. So in terms of understanding Jack Ma, he set out to make Alibaba to solve a particular social problem. He saw this particular market opportunity, getting small and mid-sized businesses in China to be able to compete against larger entities. And he also has very unique ideas about shareholders in the pecking order. As you can see, quote, first the customer, then the employee, then the shareholder. Now, ordinarily, this is something we don't entirely like to see, but in this case, we feel that that philosophy has engendered itself to provide Alibaba with an amazing customer experience and given it a moat that we believe makes it a buy. So in terms of just putting China in perspective, well, here are these intense numbers and a lot of statistics about growth slowing, but if you look at consumption per capita, it's just starting to ramp up. Chinese consumption per capita in 2012 was just like the US in 1964, so we believe there's a long way to run. And in terms of e-commerce capturing a good bit of that growth, as you can see on here, new internet users are every year exceeding Canada's population, and an increasing majority of that are online shoppers. And the good thing for Alibaba is that with its close to 80% market share of China's e-commerce, Alibaba is synonymous with e-commerce in China. So, overview, most of its revenue, 12.45 billion currently, comes from Chinese retail. It's very active in the M&A space globally. Does 90% of the revenues are from China. Market cap around 216 billion USD. Currently, on a forward basis, we're looking at a PE of 30. Ordinarily, we find that too expensive for our blood, but we believe that the immense demographics and Alibaba's moat provide this as a buy going forward. So we have 3 points to our investment thesis. The monetization rate is set to rebound. The stock was down in the past month because of concerns about a slowing monetization rate. We feel that that's just a short-term factor. 2, the Alibaba user experience, the ecosystem. They've got a huge moat and is only getting bigger. 3, we like the strong balance sheet, the potential for global upside, and in our view, there's limited downside. So with that, Mitesh is going to talk about monetization rate.
Thanks, Ben, for covering that. So what are the key drivers for Alibaba? So one would be the user growth, the registered users that they have, and the second would be like how are you able to monetize? How much money are you making on those users? So if the user growth is considered as positive for the last many years and is projected, so that's not a concern. What the concern is that how much money you're making on each of those users. So if you go forward, the monetization rate has gone down and people have raised concerns about it. But if you go back and see like what was the reason behind that, the first we need to think that what is Alibaba trying to do over here. Like if you look at the e-commerce space, it's like 76%, it's a market leader. And it also realizes that if you have to maintain that market leadership position, you need to be in mobile commerce. So that's what I call m-commerce. So you need to be there. So these graphs will help you understand that there's a big push towards mobile commerce. And we also need to be cognizant of the fact that unlike US or the developed markets where there is a good, pleasant experience of retail, you could go to Macy's, you go to good shops and have a good time. The Chinese people across China, you'll have good malls in Shanghai and in big cities, but across the country, they don't have that option. And what they have left with is like a better experience of doing e-commerce on their phone or the PC rather than standing in lines in China. So that is a boost. So you're a market leader, you want to maintain this position. What do you go about doing? So you need to incentivize people, or need to incentivize businesses to put their advertisements on your mobile app rather than doing it on the PC side. And that has not been the case. So if you look at business to customer, that's more of the Taobao and Tmall environment. that's where you get advertising plus commission. That has not been prominent on the mobile space, so that is a concern. And second is that when you're looking at Taobao and Tmall, you want to have both advertising and commission-based revenue, and that has not been the case. So the key behind this is they came up with this incentive scheme in which they were incentivizing business holders to put on advertisements on mobiles, and that's where we saw that the mobile GMV has dropped down. Over here, what we have is the Taobao GMV, the Tmall GMV, the PC GMV, and the mobile. The mobile is the one with the bigger excess. So although everything is going down, what you'll notice is that the gray one is steeply going down, and they need to focus on the mobile space. So the mobile growth has been greater than the PC growth. That has led to a lower monetization. But they have come up with these schemes incentivizing the businesses to move their advertising onto mobile, and that's going to go up. And if you look at the second piece, the Taobao growth has been greater than the Tmall growth. Taobao is more of the customer to customer compared to Tmall, which is from business to customer retail. So that has led to the monetization rate. But based on the incentive scheme that is put into place, we're very confident that this is going to turn around. And if we just extend the first chart that we have over the next 4 quarters, we see a sizable increase in that. The short-term impact was that the merchant costs got low and the user experience was improved. They put in some keyword optimization in which the clicks that you need to reach to the object that you need to buy have been reduced. So the better user experience, reduction in cost, that's going to increase the consumer discovery and the conversion rate, and the monetization is going to go up. So this is the biggest concern of the market, and we think we have a contrarian view on that. For the second point, in which about the Alibaba ecosystem, Ben is going to talk about that.
So ad search video. This is the Chinese market as a whole. While growth rates are going down, they're still high mid-teens, low 20%. So there's still tremendous market opportunity here, and Alibaba has a piece of many of these pies. And there's an Alibaba product for everything that we think of in the U.S., from Dropbox to Uber, PayPal, and so the ecosystem and the network effects from attracting more and more businesses and customers, and making the user experience more seamless, we feel is very strong and will only continue to get stronger. One thing we thought about is, this is not just your typical internet stock. It is a disruptor, but it is the status quo in China, being synonymous with e-commerce. And all of these big players, Alibaba, Baidu, Tencent, they are engaging in a lot of tech M&A. So they are scooping up the potential disruptors and incorporating them into their businesses. So this is why we think the moat will only continue to grow.
Yeah. For the third investment thesis that we have is that they have a strong balance sheet in excess of billions of dollars on their balance sheet and cash. The second is global upside. There's unlimited global upside. They're already a big player in Brazil and in Russia. Both are around 17 to 18 billion dollar markets in current price. And if you see AliExpress, that's the brand that they go globally. It's like very close to eBay and Amazon in Brazil, and it's in the top 10 websites and the biggest e-commerce website in Russia. So there's a big global upside that is possible. People talk about what is their domestic space, that they have a penetration of 42%, 37% coming from the urban and 7% coming from the rural areas, which is set to go up with the increase in mobiles, people having access to apps through smartphones. So we are very bullish on the upside. But what is the downside that we have? We ran a bit of numbers. So currently they have around 350 million users, and all of them spend around 8,000 Chinese yuan per active user on annually. So we just put this in our DCF analysis and came up with a sensitivity. So even if they maintain the same average spend with the same number of active users, if you go over here, the stock price comes down to 71, and that's from the current price of around the high 80s. That's a very limited downside. So you have a lot of cash, you have unlimited upside, and you have a limited downside. So that is what really excites us about this opportunity. But with everything, there are risks to this investment thesis. That's what Ben is going to cover.
So a lot of these are very large, very important risks. We do. I'll just run through them. We're happy to talk about them more in Q&A. Obviously, the lockup expiration, only 14% of shares were offered in the IPO. It was actually above. JD.com had 7%, so we do see this large share overhang, but we think of that as a buying opportunity. We're looking a year out. We think that there's still going to be, Alibaba will be able to show good results going forward. Corporate governance, the Alibaba partnership will always control the majority of board seats, yet they'll only hold 14% of the shares. Also a concern, the legal structure having to do with Chinese nationals being the only ones allowed to own certain types of businesses, so they've structured them as variable interest entities. Also government risk, of course. There are many current business practices that are tolerated by the Chinese government. This could, of course, change. Then there was recently a headline about a Chinese regulatory body criticizing Alibaba for not doing enough about pirated goods. These are all significant risks, but when we think about the current valuation and the demographics going forward and the size of the moat, we still believe that we would be compensated for taking these risks.
Yeah, so for in the interest of time, I'll run through the valuation. Like we put in our assumptions. The bear case is something where e-commerce technology innovator comes and disrupts the industry. There could be a taxation issue on the customer-to-customer Taobao business, corporate governance issues, a margin compression. A bull case would be more of like better than expected mobile monetization rate in the next 4 months, accelerated revenue growth in the international markets, Russia and China. They don't have a big footprint in India. That is something that could happen. And better than expected GDP growth estimates. So these are the numbers. Being a technology company, we are more confident of the, we have more faith in the multiple numbers, and we think that the sum of parts or the DCF would give a lower bound to the numbers, because if you look at 10 years before Google, the DCF would not predict what price it is at as of now. But we're still taking a conservative look at the valuation. Our price target is 110. These are the base case assumptions. We could go through them. It's like very simple, like a growth rate of around 5%, EBITDA margin of 53%, and revenue growth of 43% in 2016. And if you compare all the three valuations, compared to the current valuation of 40.7, we are looking at a PE ratio of 50. Compared to for 34.1 EBITDA is like 36.8, and that pretty much covers from the valuation standpoint. So as I said again, like we are more confident of the multiple numbers, but just to be on the conservative side, our price target is the DCF number. And to re-emphasize, monetization rate, because of the incentive structure and the movement to mobile, that has changed. That's taken a downturn. Market is not pricing it properly. It's bound to rebound in the next year or so. Second is the Alibaba ecosystem that is required, and that is a deterrent or a moat and a deterrent to other disruptive technologies to come in and take their market share. Third is a strong balance sheet, big global upside, and a limited downside. $70 I'll take is the downside number that we came up with, and we'll take it any day. So that's our pitch. I hope all of you rush out of the presentation and buy the stocks, and we made a good time. So thanks for having us over here. Thanks for the judges for coming over, and yeah, we're open to any questions.
So when you base your valuation multiple, why 50 times earnings?
Yeah. So if you go to the valuation bit, so what we did is that the 50 is the PE ratio. So what we did is like more of a part of sum of parts, and we looked at Chinese e-commerce, international commerce, and the cloud computing. So these were the three big buckets in which we divided all of them, and we took a multiple adjustment at each point of time of 50 basis points, considering that it has international risk and company specific, and the corporate governance, the VIE corporate structure that stems out of like customer first, second employees, and third the shareholders. So we took those discounts, and then based on that we come. As far as the EBITDA and the gross profit numbers are concerned, we incorporated our monetization rate expectations into the DCF to come up with those numbers. So
you have 210 times their cloud business as a multiple. So what part of the valuation is ascribed to the cloud business? It's only
1% of the multiples, and if you look at the comparables that they the comparables that they have, like what we took is the US companies that are there in this space and the current multiples that they are working on. So
do you see something unusual in that cloud computing calculation?
Let me go through that.
Well, yes, it would be quite different if you took that.
Well, there's one that's 3,200. Yeah, that's probably skewed multiple.
I agree.
Yeah, but yeah, we're looking at P multiples and they don't have those numbers for that, so we didn't consider that. But yeah, definitely that is something that we should have taken care of.
So overall, 50 times multiple. How does that compare to some of these companies?
So if you look at the Chinese e-commerce space, if you look at it's like if you look at Jume, or if you look at Webshop, it's like 2,000, and JD.com it's 30. But the problem with these companies is that they don't have so JD.com is something that Tencent owns, and it's a single standalone e-commerce place. Whereas if you look at Alibaba, it has Taobao, it has Tmall, it has Alipay, which has more than 50% of the payment market. So what we think is that the ecosystem impact that it has, it's a moat that it has, it requires a bigger multiple.
So JD, tell us about JD.
Tell us about JD. It's very similar to what Taobao.com is, and it's where people it's like an eBay it's very much similar to eBay, and
most of JD's revenue comes from the marketplace or selling directly?
I'm not sure about that. Yeah.
So JD is mostly direct sales. What's the equivalent in the US?
Amazon.
Right. And Alibaba is all marketplace, right? They don't do any direct sales. What's the equivalent in the US?
eBay.
eBay, right. 10 years ago, who do you think was bigger, eBay or Amazon? eBay.
Yeah.
eBay was big, right?
Yeah.
What's the difference between Amazon and eBay now?
Amazon is much bigger.
Why do you think that is?
Your businesses involved, right? I mean, rather than.
So what Amazon did was they started with the direct selling business, right? And they've never made a penny. Right? They just sold it, basically cost sometimes a little less than that. And they grew to a size where they had all the customers. Right? They still didn't make any money. And then what they did was say, well, we already have all the customers. We have reached all the customers. Let's have other people sell through our platform. And now most of their, well, more than all of their profit comes from doing that. And it gave them the ability to grow at the super high rates, 20-30% for the last 10-15 years, which is why they're bigger than eBay. Right? Because eBay stayed as a marketplace and it was completely dependent on its sellers to get customers and to retain them and to grow. And so they have only grown maybe 10% CAGR over that time.
Yeah, but
what's to prevent JD from doing to eBay exactly what Amazon, to Alibaba exactly what eBay did to what Amazon did to eBay?
Yeah, so what Amazon did was basically what you said is vertical integration, built the supply chain and then got all the users and then got other merchants to sell on that. Compare that to eBay, which has always been a marketplace thing, and they had this PayPal that they spun off right now. So comparing eBay to Alibaba would be a big stretch. So I don't think they don't have the ecosystem that we mentioned.
It was growing 30% 10, 15 years ago as
But it
well.
didn't. So basically, when you look at Alibaba, it's like a whole portfolio of companies. You have Hulu. You have they also have AliExpress. It's similar to like if, Amazon had FedEx or DHL. So the ecosystem that we talk about over here, if we are comparing that to eBay, I think it's eBay is only one company out of this. So I totally understand the argument.
Profit comes from.
Currently, it's coming from the marketplace, but what the point I'm trying to make at this stage is that JD.com to do that to Alibaba would be. We personally feel that it's not possible because of the philosophy of Jack Ma, where he is a dynamic entrepreneur. If he sees something like that in China, we're investing in the company and in the entrepreneur. More from like a VC type of investing. If you're looking at this company where you believe in the team and then believe in the product, it's not something that has not been tested. It has tested in the market, and we believe in the management team that it will take steps to address anything like that. Apart from that. Alibaba itself has done all the things that Amazon done, like it's a vertical integration, and not only that, it is diversified in other stuff, something like streaming video, music streaming, and stuff like that. So I don't think so that's a good comparison, but yeah, it would be nice to dig deeper into that and come up with analysis.
I'm still having trouble understanding how the market presumably gets a lot of this, that your views may be more bullish than the market as a whole, but why do you believe that, like just looking at the PE multiple, it's traded at almost 41 times, but you believe it's more appropriate to trade at 50 times? How do you justify that? And the EV multiple, it's also a premium, not quite as significant a premium, but how do you justify that jump? It's not that you're expecting higher earnings, it's more you just believe that the market is misinterpreting the multiple that should be attached to any given level of earnings.
So in addition to the multiple expansion, we do expect that earnings are going to grow because of the monetization rate picking up. So in addition to that, our own hypothesis is that because of the ecosystem effect, where you have so many people using Alibaba different products, if a new person is going to come in and wants to use something else in the internet space, it's more likely. It's more like having a person who has a Mac. It's more probable for him to go and buy an iPhone rather than buy an Android thing, compared to anyone else who has an Android phone of say Samsung. If he's going to buy a laptop, it could be of any other brand. So because of that and because of that moat, we think that the higher multiple is justified.
Well, but it's already trading at a multiple that reflects that, right? I mean, how do you jump it an additional 10 points?
So if we go back to the multiples discussion over here, if you look at the comparables and if you look at cloud computing, it's just that is a huge multiple. That's just 2 to 3%. So going forward, that type of business is also going to grow. We could go deep into like how much it increases, how it impacts. But with that ecosystem and with increase in diversification in different businesses, I think that is justified.
And if you were to look at in recent quarters, their growth and their anticipated consensus growth and top line and EBITDA, how does that compare to some of the more established U.S. majors? Because if it's in line or a slight premium, I mean, I don't even know where it is, but if it's not too dissimilar, at some point, once the fluff wears off, they could very readily trade at 20 times PE multiple in the case of Amazon.
So that's what we mentioned in the first slide. Somehow the screen is not working at this point. So what we are saying over here is that if you're comparing with the American businesses, we're already somewhere over here, and those businesses are very US centric, and the per GDP consumption for Chinese consumers is going to still see this exponential growth going forward. So that comparison with US e-commerce businesses would be, I think, far-fetched.
But how has the top line growth? What's been the change?
It's been growing in excess. The revenue has been growing in around between 45 to 50% quarter on quarter.
So you have 2016 revenue growth 43%, and you're pointing out the last quarter they grew 40%. What's going to make revenue growth accelerate?
The monetization rate, as the monetization rate,
So you think monetization rate is going to go up?
yes.
Let's go back to those charts.
Yeah, so this is what we are right now. The dip that has happened in this quarter has led the market to believe that it's going to go down further.
Do you know what their monetization rate on PC is?
I don't have the exact number.
It's about 3%. Do you know what the monetization is on mobile?
It should be around 8 to 10%.
It's about 2%.
Okay.
So on mobile it's 2%, on PC it's 3%. 40%, 42% of their revenue already comes from mobile. That's double what it was last year.
Yes.
Where do you think that's going in 2016? What do you think, what
So-
percent, if it was 20% last year, it's 42% this year,
Yeah.
what do you think is going to be next year?
So it's going to be somewhere, our expectation is somewhere between 50 to 55%. And the difference that is going to be there in the prior quarters and the quarters going forward is that when you look at mobile and you look at the mix of people, there are more C2C people who were using the mobile app. To incentivize them, that was exactly the point in the investment thesis, that to incentivize them, the merchants to come and advertise on the mobile platform, they're giving them discounts at this point of time. Over the next two quarters, we expect the merchants would have moved the advertising spends from the PC to the mobile space, and by that, not only we are getting commission, but we are also getting. So why is PC greater than mobile? It's because it's advertising plus commission. So we expect that shift to go up. So more people are going to use
So where
mobile.
do you think the 2% for mobile is going to go in 2016?
3 to 4%.
Their PC is 3%.
Yeah.
How could it possibly be higher on mobile where I can advertise significantly less than I can on desktop?
Because the algorithm that they're using for consumer discovery, so something like the number of could you talk on the change in the keywords, the tail keyword?
Only the highest
Yeah,
level.
yeah. So basically, the idea is that the number of clicks that you required to get to the product that you wanted have been reduced by the change in the tail keyword search that is present. Now, if you look at that, that means that you'll be able to target your own consumer in a better way. So that's why if you're advertising on Facebook, that's through a premium to when you're advertising to Google. So I think those things will play along in addition to the advertising revenue also.
When you advertise on Facebook on a desktop versus Facebook's monetization on mobile, what do you think is bigger?
I think mobile is bigger. I haven't seen the numbers.
Same for Google. Desktop is always bigger than mobile because on mobile, remember, it's a very small screen. You can only have 5 or 6 items on the screen. In desktop, you have several areas where you can advertise. Google and Facebook make the most of that. They advertise in the stream, they advertise on the side, they advertise on top. Desktop monetization is always going to be higher. So if 60% of their revenue is coming from desktop at 3%, and 40% is mobile, 2%, and next year that flips, or 60% mobile and 40% desktop, what do you think is the monetization rate?
But that still doesn't consider like the increase in the ad spend that we expect in the
Before
mobile.
the increase in the spend on mobile.
Yeah, the monetization will be flat or go down.
You have to hope that they catch up a tremendous amount in their mobile monetization, which neither Facebook nor Google have done, in order for that to happen.
Yeah, in a way.
And then why would margins go up? You point out they were 42% last quarter, and you're saying that they're going to go to 53% in 2016. How would that happen?
So the margin numbers came from the DCF model that we have. This is a DCF. Okay. We just put in our assumptions over here and then came up with that number. So I have no good answer for that as such.
Can I stop you real quick?
Yeah.
Your train of thought, but back on the DCF analysis,
Yeah.
how are you calculating your terminal value? It's such a significant amount of your overall
Yes.
value tied up in
Yeah. So the way we are looking at terminal value is that in 2024, what do you expect the inflation and what do you expect the GDP growth rate of China to be? And based on the macroeconomic studies that we read of IMF and other stuff, we expect inflation to be around between 2 to 2.5% and the GDP growth rate somewhere in that space. So that's why we thought that the terminal rate that we'll put over there would be somewhere between 4.5 to 5%. And the second, when you look at the discount rate, we, in addition to putting the normal WACC, we were looking at the risk-free rate and everything. We added a country risk premium of around 2 to 3% because by that point of time we expect it to be more of a developed economy, but still put in a country risk premium. So the WACC that came around 12%. So based on that, we came up with this number.
Can I ask a simple question?
Yeah, sure.
What's the moat here again?
So the moat over here is the current users that they have and the whole ecosystem that they're building around that. So they have this whole e-commerce business.
Yeah.
And people are there are more than 350 million registered users, active users on that. Now for the way they have been able to, so something like Alipay, that's like the PayPal counterpart over there. That
Every one of these is like something else, right? So that
Yeah.
doesn't seem like a moat. I get China's big,
mm-hmm.
but if I can wave a wand and go, okay, so China's not a communist country anymore, and let those competitors in,
Mm-hmm.
does the moat still hold, or is it all predicated on we have access to this group of customers and no one else does?
I think it's a bit of both. So if you first, the probability of something like that happening is very, very less going in the next 5 years. And the second thing is, if someone is using, say someone is using Google at a point of time, what is the probability he moves to Baidu? So the same reverse logic applies over here as well. If someone has been using Alibaba, Alipay, or has been using Youku Todo for the online streaming, it doesn't make it's a very sticky factor. I've talked to some Chinese native speakers who are currently studying with us, and still they use Facebook, but they still use Run. That's their own Facebook. So my whole
Just
point.
to narrow it down a little bit, if we turn Amazon loose
Mhm.
in China tomorrow, lower the barriers head to head, here we go. Who wins?
From my expectations, it would be Alibaba because Amazon doesn't have those. The first, the active users, as he mentioned, and second, the tie-ups with the retailers. So Alibaba would be in a better position through its Tmall brand, which is already present in China as of now, to cater to the same audience. And I'm not sure how good. I have not seen any US company being able to work on a Chinese build a Chinese product that is good and is well received by the Chinese people. Given irrespective of whether the government has done well or not.
So the moat is, the brand is China specific, and outside China brands have not been very successful.
Yes,
in
and
entering.
the regulatory landscape is more likely to be the same than the otherwise.
Where's Alibaba registered?
Cayman Islands.
It's not really a Chinese company. Why didn't
So-
they get preference?
It's all about the brand perception, right? Irrespective of whether you are, even if it's Yandex is the biggest search engine that's used in Russia, it's not listed. It's listed in London Stock Exchange. So that's brand obsessive. Yeah.
We've got about 30 seconds left for one last question.
Yeah.
Real quick. So your terminal value looks about 15 times EBITDA
Okay.
at that point. There's got to be, do you take into account the risk that the market's going to start discounting that type of valuation multiple sooner?
Yeah. So we did that. So we did valuation in two ways. First, using the number of active users and the average spend, and came up with these numbers, the DCF and all the things that we have attached. And in that case, if it goes down, and it would go around to $50 to $60. But the valuation that we have put over there is the base case that we have assumed. So if you want to see if the market goes down from 350, if the market goes down from 350 and if the spend decreases from 7,000 Chinese yuan, then you see the expected price to go around $55 to $50.
I'm Jim Bright. This is Adam Kammel. This is Alex Durgan, and we're Team Dundee. We're here to talk to you about how the largest e-commerce player in the Chinese market is under-earning. Alibaba, we recommend to buy a $127 price target. We believe over the next year that the stock is going to reflect the true earnings power of the business. Our price target reflects a take rate moving up towards competitors. Non-core businesses non-core businesses and potential new verticals reflect an opportunity to unlock additional value on top of this. So what is Alibaba? We view Alibaba as an ecosystem with e-commerce at its core, namely Taobao and Tmall. Taobao is their legacy business, a consumer-to-consumer model similar to eBay. Tmall, their faster-growing business, is with more favorable economics, might I add, is quite similar to Amazon. Business consumer versus consumer to consumer. So this just gives you a breakdown of Tmall's growth relative to Taobao. You can see that Tmall is both are growing, but Tmall's growing faster. So Taobao is essentially all of consumer-to-consumer e-com in China. Tmall also has a very, very strong market position with majority of the business, almost 60%, with JD.com as their closest competitor. So when you think about China, we're talking about a country where the incremental purchaser is going to be on mobile. They're not on desktop. And Taobao and Tmall are extremely well positioned here with over 85% of mobile e-commerce. So just to recap on Alibaba, we find it to be almost a technology conglomerate. They have the ability to leverage ancillary businesses to control the development of the Chinese online ecosystem going forward. Said a different way, wherever the growth opportunities may exist, outside of e-com, Baba's portfolio allows them to capitalize on this. So just in terms of recent financial results, sales and EBITDA are increasing very rapidly, and feel free to reference this during Q&A.
So to set the background for you, Alibaba IPO'd 5 months ago, $68 a share. It opened at $93. It reached $120 in November, and it's now at $87. Yahoo and SoftBank own a significant bit from their early investments. Yahoo is spinning off its Alibaba stock into a SpinCo holding company. We believe that, so that will happen at the end of the year. We believe that Alibaba will buy those shares at a discount in 2016 or 2017. In the last earnings, Alibaba fell 9% after its revenue failed to meet expectations, but GMV actually beat consensus, and that's really what's important here because that reflects Alibaba's competitive positioning. It was a monetization rate that fell short. We're not too worried about that because we think monetization rates can be raised at will by Alibaba, and that right now they're just keeping it low to increase their market share. So looking at the take rate, Alibaba takes a significantly lower percentage from its sellers than its competitors. JD.com is the closest competitor, it's at 6%. eBay takes 9%. Amazon.com.cn takes 8%. On the top right, you can see Yipit's estimates of take rates as well. The take rate varies based on the type of merchandise. And we think now that there's dominant market share, they have 80% market share, they are a price setter. And they can change their take rates at will. Even if they double it, they'll still be the lowest cost competitor. So we're going to estimate earnings based on the increase in take rate and also the increase in GMV going forward. So their long-term goal is to reach $1 trillion. The Chinese market should probably be about $1 trillion in 2018 or so. Remember, they have 80%, so this is not 80% market share. This is not too far off. The Chinese e-commerce market is growing at a very rapid pace. They increased at 46% in 2014. So we're going to combine that 2016 GMV estimate, about 516 billion. You can see that's right above the chart on the right. And if we put a 5% take rate on that, what would happen? That'd be $26 billion in revenues. So that's an increase of 17 billion. You can see the orange over there. That's 17 billion. 3.7 billion is going to come from the incremental GMV, and the rest, the 80%, comes from the increased take rate. Now, to be clear, we're not saying that Alibaba is going to immediately raise its take rates or double its take rates. We're simply saying that you should value the company based on its true earnings power. That's what a valuation should reflect, since we do believe this is going to eventually happen. So how does this affect earnings? Looking at EBITDA, the incremental GMV will drive 2.6 billion in EBITDA because there's a 71% gross margin on the 3.7 billion in incremental revenues. The take rate increase will drive 13.3 billion because that should go straight to EBITDA. It's just a pricing increase. There will be some incremental SG&A that we're modeling in of $1 billion, consistent with historical ratios of incremental SG&A to incremental revenue. That will leave us with 2016 EBITDA of 21 billion. Remember, that's the potential EBITDA that they will be able to get if they were to increase their take rates to still be the lowest cost competitor. So let's look at take rates. Is this realistic? We think yes. The PC monetization rate that's non-mobile is around 3%. The mobile monetization is really what's been dragging it down. Mobile has become a larger percentage, but mobile is converging with PC. So if they can get it up to 3%, they don't even need to explicitly raise take rates on their sellers. They'll just have a higher take rate because of the mix. Same thing with Tmall and Taobao. Taobao takes 2%, Tmall takes 3.5%. Tmall will become a majority of Alibaba GMV in the next couple of years. And as that happens, take rates will simply converge to a higher number, closer to Tmall's take rate rather than Taobao's take rate. While our earnings estimates are based on these take rates and GMV increases, we also think Alibaba has significant opportunities from tangential, from non-e-commerce growth.
So to cover some of the tangential opportunities, first of all, I'm going to speak to cloud computing. On the screen, you see Gartner's forecast for cloud computing in Greater China. We think Alibaba has the capacity, the excess capacity, to to basically act as Amazon Web Services act in the U.S. This isn't a market that Alibaba's pursuing intensively with limited market share, but we see great potential in this area, and if Alibaba decides to pursue this market, potentially faster growth than Illustrated. Another opportunity is in logistics. Alibaba is very closely integrated with the companies the supply chain that delivers its products and has a stake in China Smart Logistics. So we believe that Alibaba is very likely to, at some point, layer on a cloud software supply chain management tool on its logistics ecosystem. When we consider that, we're thinking of something like a Descartes being the U.S. equivalent. And again, I think that's a small piece of the stack here. When you look at 16% growth, that has a likelihood to grow faster than that. Another opportunity comes in finance. You can leverage Alipay, which is an entity for whom Alibaba generates 30% of its business, but has a lot of runway for growth outside of Alibaba. And the sell-side models Alipay in a wide range of $60 to $200 billion in value, which translates to $8 to $28 per Alibaba share. Other consumer finance products include Alipay Wallet, which already provides people the opportunity to invest via money market accounts. We can see that platform getting extended into a full-on investment management platform for consumers. And lastly, consumer ratings. Alibaba has more information than anybody else on consumers. So we believe that it can basically provide the FICO score equivalent And when we think of that, we're thinking of an Experian or an Equifax type of business model, very healthy business model, but instead of an oligopoly, you have the potential for a monopoly there. Another couple areas, pie in the sky thinking, Alibaba can layer a social network on top of its e-commerce platforms, increase the stickiness, increase how much time users spend there, and add revenue. Furthermore, Alibaba recently mentioned on a call, Alibaba Pictures, to take advantage of the movie industry in Greater China going from 3 billion to something closer over time to what it is in the US being 50 billion. So now I'll discuss our valuation. We're not including all these growth tangencies in our valuation. We really break it down to two simple drivers, the multiple and the take rate. And we start out by looking at the hypothetical valuation with a 5% take rate, and that's what the disaggregation of returns is about. And as you see, you have a lot of it driven by the take rate, and then on the back end, multiple contraction driving you back down to 84% returns. But really, it's about what the sell side will think 6 months forward, and the investing community will think 6 months forward at this point next year based on take rate increases that occur over the next year. So being that today it's modeled in the high twos, and Alibaba is likely to exceed that in our opinion, we think that at this point in a year, people are going to be looking forward and thinking something around 4%. And we apply a 25 times multiple based on comparables to get to a base case return of 47% or $127 share price. So quickly, this is bullish to mention the risks to our forecast. I'd like to mention that Alibaba may not be able to maintain its dominant market position. It's definitely facing some competition from JD.com. If take rates are not increased, the corollary to what I said earlier is that the market will not look forward and increase take rates in its forecasts. And the tangential businesses that we mentioned, they may be dilutive to margins and cash flow generation in the near term through R&D, SG&A, and CapEx. And lastly, the take rate can get fuzzy because the GMV accounting is aggressive. So we need to be skeptical of what is actually going on with the take rate because of the way returns are accounted for. So that concludes our overview of Alibaba, and we're happy to open the floor to questions.
So you have a chart, this page, page number. You're saying Taobao's rate is 2% and Tmall's rate.
Yeah.
If I was to challenge that assumption and tell you that Taobao is probably closer to 1 and Tmall's actually closer to 5, and you brought up back the chart, the competitive chart for take rates. Which chart is that?
Yep. There you go.
So then, are the other 5 here C2C or B2C?
Mercado Libre and eBay would be C2C. The rest would be B2C.
Let's look at the top, the Chinese.
Okay, at the top. I guess those would be B2C. Yeah.
Right, so like Tmall, they're B2C. And so if Tmall is at 5% in that range, and those are all B2C, are they that different?
Tmall does take 5% take rates from certain merchandise. So for example, it's really the ones that they're dominant in that they take a high take rate from. So clothing, apparel, household goods, those are 5%. But 3C, that's camera, computers, and consumer electronics. That's 1.9%, I believe, on Tmall. Whereas JD.com, that's where they get most of their revenue, 3C, they're at 6%. So it's the same merchandise being sold on Tmall.
Why do you think JD can charge more for 3C?
JD has a better logistics program, so their shipping is quicker.
How quick?
2 days. About 2 days.
Some hours.
Well, that's pretty good. Well,
Do you think Alibaba can do that without owning their own distribution and logistics?
we think they have 80% market share, and that it's worth it for them to invest in logistics. Right now, they're investing in China Smart Logistics.
China Smart Logistics is what?
How many days, you mean?
What is it? What kind of company is China Smart Logistics? It's a software company. It's not DHL, FedEx. It's a software company. They're investing in having better software to help the 100 DHLs and FedExes of China help them deliver. How many geographies do they think they have same-day delivery?
I suppose you'll
Not
let me
many.
know.
No? Right. So JD in 45 Chinese cities has same-day delivery. Alibaba has no same-day delivery. So do you still think they can raise their take rate to match JD's?
So we look at where JD has that capability on delivery, and it's in the top cities, and where the growth is coming from, which is in second and third tier cities. And we believe that Alibaba will still, for quite a period of time to come, have that power in most of the market where the growth is coming from.
So you think JD's done with 45 cities and they're not going to do expand same-day delivery to the other cities?
It's going to be incrementally harder. The economics of it are going to be worse. I'm not familiar enough with JD's business to speak on it, but just conceptually, when you're talking about small towns that are far off from major areas, I think the economics
How
get a lot
many
worse.
cities in China with more than 1 million people?
A lot.
Not small town.
What was that number?
Well, I think one other way you can think about it is Alibaba is a price setter. If Alibaba increases its take rate to 5%, JD is going to increase its take rate as well. It'll look more like America, where eBay takes 8.8% and Amazon takes 13%.
But you know, I'm new to this business model. It's a very high multiple stock, so that generally takes away my interest. But to what extent are these large market share that they have a function of the low take rate? And if they just increase the take rate, that they will lose that market share. I mean, it's a lot of companies can easily, grow market share by throwing away business, as the Japanese did for decades. It was a market share model. It wasn't a let's create economic value model. It's just let's grow for growth's sake alone.
We
How do
agree.
you know that they can increase that and actually protect their margins?
Well, they'll-
or their market share.
Yeah, at 5%, they'll still be the lowest cost competitor.
But as he pointed out, there are reasons for that. If you have distribution logistics capabilities that Alibaba doesn't have, there's a reason why those differences in the take rate differential. Do you agree with that, or?
We do think that there is going to be a small difference. That's why we don't have it going up to JD's take rate. I think if someone who's not taking that into account would say that the take rate could be higher than JD's because they have such market dominance. And yeah, we're not saying that.
I think as you think about the more mature American competitors too, eBay at 8.8%, Amazon at 15.1%. Obviously, JD is a very, very strong competitor, but if you look at the more mature markets and think about where they are on their take rates, you can get a little more confidence on a 4% take rate going forward. And we're only talking about 160 basis points.
Can you bring up this chart? While you do that, let me ask you, what do a travel software company, a soccer team, and a movie studio have in common?
This sounds like a fun riddle.
All things Alibaba has bought over the last year. What do you think happens when you buy all these types of businesses? What happens to your margins when you buy all these types of businesses?
Well, we alluded to this in the risks that these investments into tangencies could definitely hurt the margins.
Do you think that's happened?
Not in a significant way up to this point.
82% of their business is still China commerce retail.
On the revenue side?
Yeah.
Because these things don't generate any revenue,
Right.
but they generate a lot of expenses. Do you think Jack Ma is done buying things?
I'm not going to read into what Jack Ma's going to do. But he's so far proven to be a pretty good venture capitalist. Tmall started in 2008, and it's grown into a BMF. They started Alipay, and it's grown into the dominant force. They've grown a lot of things from nothing, so we think they're worth paying for.
So this is kind of the magic leader thesis here now, right? Meaning, this guy's like.
Well, when we're
Yeah.
discussing this specific page,
Like,
or in
again,
general?
as taking a step back as a value investor, I'm looking here going, okay, there's a lot going on here. So who's ever in charge of running a lot going on here, better be really good and very disciplined. And I think what I heard there is, what those things all have in common, their ideal owner is a very wealthy individual with a lot of free time on his hands. This looks like this is a full-time plus job, even if this guy is the best business executive of our generations.
I'd just point to the fact that these industries are nascent, and China's still in land grab mode. I don't think this is a value stock, and you. I'm not going to try to justify it through a value lens. And if I was a growth investor, I'd think about what the TAMs are for these markets. And like the movies piece, when Alibaba thinks of it, it's thinking today it's $3 billion. In the future, it'll be more similar to the U.S., $50 billion. Again, I'm not sure how. It's definitely going to hurt in the near term when you make these investments, but if China still has all these nascent industries and it's in land grab mode, you may be in favor of such acquisitions.
An element of your thesis that was kind of value oriented is reversions up in take rates. And you hit on a couple of things, but JD has distribution capabilities that Alibaba does not, right?
Yes.
Does JD have distribution capabilities that in the US Amazon doesn't have?
Well, we think distribution capabilities are essentially a commodity product. It's not difficult for Alibaba to do that if it wants to. I'm not sure exactly what the difference would be between JD and Amazon
I'm
in that
thinking about
situation.
normalized take rates here.
Yeah.
And I see Alibaba at the low end and I see Amazon at the high end. And the value investor in me is like, okay, so that might be low, that might be high. But what I think I heard here and in your answer to the question is JD has a different business model that I think involves more capital and real assets. And the reason why I'm asking that is if JD's take rate goes up, and it should have a higher take rate if it's got a better business proposition and or more capital required to do it. Doesn't that create a take rate umbrella for Alibaba to come up? That was the part of your investment thesis from a value standpoint. I was
Okay.
like, oh, I can
Good.
see where that could happen. Is that even remotely true? Meaning, is JD's take rate, can it move up? And can Chinese take rates revert up to the level of Amazon and some of the other American businesses? Or is it just always going to be lower because of geography?
So the inventory risk issue and the geographical risk issue, I think we're in agreement that JD could move up and provide that umbrella for Tmall and Taobao. I think that that's a very legitimate belief that they could do that. But the fact is what's that differential? So if you look at Amazon, just going back to looking at mature markets, eBay's inventory versus Amazon's inventory may not be the most perfect comparison, but if you think about about Alibaba coming up here, that's material.
Can we go this way?
Sure. What would you like to know?
You said that Alibaba's going to buy Yahoo's stake after Spinco. Where did you
Yes.
hear
Where do we get that? Okay. Yahoo has 370 million shares of Alibaba. Is that right? I should tell you, right? Okay. What they're doing is they're spinning off those shares to shareholders. So those shareholders will, they're spinning off those shares to a holding company, and Yahoo shareholders will own that holding company. The spinoff will not happen until the lockup expires in mid-September. It was a one-year lockup. After that, what will happen is that SpinCo will probably trade at a discount. So we've seen this before. Right now, I guess Liberty Broadband and Charter would be similar. Liberty TripAdvisor and TripAdvisor would be similar. Those trade at smaller discounts because there's John Malone, and everyone knows it's going to happen. That value will be maximized in those situations. So we expect probably about a 10% discount, maybe a 15% discount. This has happened before, by the way. In 2000, Seagate owned shares of Veritas, which were greater than its enterprise value. So what Seagate did was, this is 2000. So Seagate sold off to private equity its core business, and then Veritas bought the remaining shell of the company, which only owned Veritas shares, at a 10% discount. So there were about, I think, 125 million shares, and Veritas bought them by issuing 109 million shares to the holding company that just owned Veritas shares. So what happened was they were able to cancel out 16 million shares, essentially, and now they had a larger float. So we think something similar happens at Alibaba and Yahoo, where Alibaba probably buys this Yahoo SpinCo for probably about 340 million shares. That would be 330 million shares. That'd be about a 10% discount. At 40 million shares that are worth, that's what you're canceling, that are worth about $100 a share. That's $4 billion. That's helpful. We didn't include it in our valuation because it's only a couple dollars a share. But that would maybe help with your question.
What happens if Alibaba doesn't buy the Yahoo shares? And there's a SpinCo out there whose sole purpose in life is to slowly unwind shares of Alibaba.
I wouldn't expect it to slowly unwind. I expect it would just continue to hold those shares.
How long did you gave a few case studies.
Yeah.
How long was the longest one of those held of the shares of the company was holding?
They're pretty new. Liberty Broadband and Liberty TripAdvisor are relatively new, I think, past couple of years.
And they still hold the same amount of shares?
Yeah. If they were to sell it, they'd have to take a 40% tax rate. It's a 35% tax rate federal and then 7% in California, and that's tax affected to be 40%. State tax affected to be about 5%. So you wouldn't want to sell those shares. Because what Alibaba can do is it can buy those shares, and then instead of selling them, they just cancel them, and there's no tax paid.
You've given a lot of thought to the take rates on the business side, but as far as the valuation is concerned, talk us through your justification for the multiples, and why is 25 a magic multiple for this company? Why do you believe that that's where it should trade?
Yeah, we looked at comparables for that, and not on this page, but we tried to also look at growth rates. That's where we came out on a multiple, and really it's hard for us to call where it should trade, and that's why we did the sensitivity table to look at a range of multiples. This was middle of the road multiple that we used for this hypothetical valuation based on long-term take rates.
So if you take the existing take rate and the market multiple of 22 times 2015, where does it get you on that in that table?
Roughly down around just below 20%.
Unfortunately, 20x and 23x.
We've got about 3 minutes left if there are any last questions.
What are the leading social media platforms in China?
Tencent.
Tencent, Weibo is like the Twitter there. Alibaba has a stake in Weibo. We didn't provide a ton of growth in the stake in Weibo or anything. We just took market.
Do you know what JD is, what Tencent is doing with Weibo? With WeChat, which is bigger than Weibo?
What are they doing? The answer to the question is no.
It only took you 15 minutes to figure that out. WeChat is partnering with JD
Okay.
to make JD's merchandise available on WeChat for Chinese consumers to buy. So if you go back to this chart on mobile, where right now Alibaba has a lot of share, how sustainable is that if they're successful?
We actually are modeling a small market share loss to JD, and I think it's around, it's a few percentage points that we're modeling in for a decline in market share. That said, in the US, a social network partnering with an e-commerce company hasn't particularly worked out so far. I suppose it could happen in China. That there are certainly a lot of risks in investing in a company where you are unfamiliar with the culture.
Good afternoon. I'm Miron. This is Zane, Carl, and Scott. We're Team Get Shorty, and we're here to talk to you about Alibaba, ticker symbol BABA. Taking a quick look at the company, there's a current share price is $89 a share, and we're issuing a short recommendation with a target price between $60 and $68, representing a 30 to 50% downside situation. With a market cap of $230 billion, the company, from a valuation perspective, trades at a 62 times PE, 35 times EV to EBITDA, and 10 times price to book. Looking at the stock price on the right-hand side, you can see the stock currently trades right around where it traded right after its IPO. So, if Alibaba was Goldilocks, I want to introduce you to my three bears. First, an unrealistic valuation. Zane's going to go over the heroic assumptions needed to justify the current share price. Scott's going to talk about the conflicts of interest and the significant economic and control conflicts existing between Alibaba and Alipay. And lastly, Carl's going to talk about empire building and Jack Ma's mentality that we believe is going to destroy shareholder value. So what is Alibaba? Well, it's a Chinese e-commerce platform. But what we really thought about it is it's a confluence of both operating and financial assets. For example, at the heart is the marketplaces, specifically Taobao, which is China's B2B, B2C online retail marketplace, what you can consider eBay. Complementing this, there's Tmall, which we consider as maybe the Amazon for China, and Zhuhuasuan, which is the Chinese Groupon. On the periphery, there are marketplace platform, Alimama, payment processing, which is Ant Financial, also known as Alipay, which is what Zane will talk about, and cloud and web services. Also, Alibaba has made significant investments in the last 10 years, including significant investments in media, hardware, social, and transportation. So what is the online marketplace model? What really matters if you're running one? Well, we really boiled it down to two facts. Gross market value, so how much dollar value of goods are you placing on the platform, and your ability to monetize. Right? Except Alibaba has achieved outstanding growth of user buyer at the expense of sellers. Alibaba's underperforming take rate, which we define obviously as revenue divided by gross market value, is unlikely to approach global competitors. I'm now going to hand it over to Zane, who's going to talk about Alipay and Ant Financial.
So as Moran talked about, an important part of the Alibaba picture is the financial asset of Alipay, or the Ant Financial Group. And this is basically the financial services arm of what appears to be Alibaba. The biggest asset of Ant Financial is Alipay. That is the PayPal equivalent of Alibaba. There's also a money market business. They're basically managing merchants' cash that sits in the money in Alipay. SME loan business, where they're providing cash advances to merchants again. And we actually think overall these are pretty good businesses. We estimate they're worth about, the Ant Financial Group overall is worth about 50 to 60 billion, which nominally Alibaba owns about 37% of. But actually, once you start to dig into it a little further, not everything's what it appears. So as I mentioned, they nominally have a right to 37% of profits at Alipay and the Ant Financial Group. But what's going to happen is there's a liquidity clause. So once Ant Financial goes public, there's only two things that can happen. Alibaba can retain a 33% equity interest in the company, or it can take a 37% payout equivalent to the market value of the company when it goes public. However, there's a little hitch here. And if you look at this in the IPO prospectus, they actually lay it out for you. What happens is the People's Republic of China has said that a non-PRC entity cannot own a payment network. So in this case, Alibaba, which is incorporated in the Cayman Islands, cannot own Alipay or the Ant Financial Group. So therefore, they really only have one option. They have to take the payout. This is going to become very important, as you'll see in a little bit, because it creates significant conflicts of interest. Before we get to that, let me tell you a little about the valuation, how we think about such a complex company. As Moran said, we split it into two assets: the operating assets, the marketplace side of the business, and financial stakes they've taken in various investments, including Ant Financial. We value the operating side using a DCF from 2015 to 2020. We use a terminal EV to NOPAT multiple of 14x. That's based upon 15% WACC, 5% terminal growth, and 350% terminal return on invested capital. That sounds high, but keep in mind this is an asset-light business, so we think it's fair. You can review some of the assumptions we made about the company in the appendices if you want. But what are the most important things about our valuation? It really only boils down to four things. Number one is, what do you think Chinese national consumer consumption will be? 2, what percent of that will be captured by Alibaba? 3, what's the take rate? How much of that consumption are they converting, of the market value that's listed on their marketplace is converted into revenue? And 3, what type of EBITDA margin do you think they can earn on that? And this is important because it drives what we think is the fair value of Alibaba stock. And we have to ask ourselves, what type of assumptions does it take to get to the current share price, much less a level above the current share price? Here's kind of the heart of our model. It's our revenue buildup. You can see at the very top, we start at the highest level, Chinese GDP. This is taken from the International Monetary Fund. We then estimate Chinese consumer consumption as a percentage of GDP. Right now, it's about 38%. We think it'll go up to 68% by 2020, which will be at the same level as the United States, would be very high, very fast adoption rate. We then estimate Alibaba's market share. So right now, it's about 9% of all Chinese consumer consumption is transacted via Alipay, or Alibaba rather. We estimate it'll go up to 15% by 2020. By the way, eBay and Amazon combined only capture 2% of US consumer consumption, so these numbers are already very high. We then make an EBITDA margin assumption. We say it'll earn about 45%. eBay is at 35%, even though it's a very mature business. Here's a sum of the part valuation. There's a lot of numbers going on there, but basically what we arrive at is that there's a $900 billion value for the operating businesses of Alibaba. You can then look at some of the financial assets. The details are in the appendix if you want. This includes Ant Financial. And we, at the end of the day, we get to a net share price for Alibaba of $68 US dollars per share versus the share price of about $89 right now. That's a 30% downside. This leads us to our first thesis. The share price right now simply requires heroic assumptions to get to the current share price, much less above the current share price. What are some of those assumptions? I'll lay it out for you. 9% Chinese GDP growth for the next 5 years. 68% consumption of GDP. Remember, they're only at 35% right now. Alibaba captures 15% of all Chinese consumption, and their EBITDA margin's 45%. Even if all that happens, $68 per share, 30% below the current share price. Let's say, we accept that, but maybe we have some quibbles. We think the market share will be higher. Maybe Chinese consumption of GDP will be higher than the United States even. Even if you assume it goes well above the US level, and they capture 20% market share, twice what they have now, you only get to 10% above the current share price. Let's say you accept our consumption assumption and our market share assumption, but you think maybe the take rate will go up and EBITDA margin will be better than they're achieving. You still have to assume almost a doubling of the take rate and some very generous EBITDA margins to get to materially above the current share price. So we think these are really unrealistic, and now Scott's going to describe to you some of the conflicts of interest that we think are very serious at Alibaba. Scott?
Thanks, Zane. So our second investment thesis revolves around the conflicts of interest between Alibaba and internally and externally. We think that there are 3 key areas of concern that are harmful potentially to potential Alibaba investors. First, you have this issue of the Alibaba partnership. So the Alibaba partnership is comprised of Jack Ma and his close inner circle of friends. The problem here is that they appoint a majority of Alibaba's board. For example, at Alipay, 5 of the 30 managers are handpicked by this partnership. And bear in mind, this partnership has no allegiance or duty to Alibaba or its shareholders. Secondly, there is this pattern of Alibaba giving insiders a first look at future opportunities. So more recently we had an example of Simon G, who is a co-founder of Alibaba, who's given the opportunity to co-invest alongside with Alibaba in its $1 billion acquisition of Washu. Not only that, he was given a loan by Alibaba to finance this transaction. And with acquisitions in general, a lot of these transactions are completed with VIE structures, which add another layer of complexity to these transactions. But our biggest concern is Jack Ma's dual interest in Alipay and Alibaba. So Jack Ma currently owns 7.8% of Alibaba, which equates to about $17 billion. But he also owns 50% of Alipay, which has a ballpark estimate of between 25 and 30 billion, we think. So the issue here is we think that Jack Ma's interests are more aligned with Alipay than with Alibaba. And this becomes an issue if they go public, or if Alipay goes public, because at that point, Alibaba won't own a stake in Alipay. Whereas on the other hand, Jack Ma will have a controlling interest in both Alipay and Alibaba. It's not inconceivable to think that Jack Ma could extract value using Alipay from Alibaba. In fact, it's specifically called out as a risk factor in Alibaba's IPO prospectus. So if all of these conflicts of interest are not enough, another key concern is this notion of empire building, which Carl will get into.
Thank you, Scott. So we do think Alibaba is trying to build an empire, and that's not necessarily a bad thing. And the rationale behind it is building an ecosystem. But having said that, what worries us is pace of acquisitions and what they're buying. So they spent about $10 billion in acquisitions since 2013, and of which $7 billion was in 2014. And about $1 billion was spent in 2015 of January alone. Here I'd like to quote Jack Ma. He said, "We want to be a zoo with many animals." So what kind of animals are in the zoo? They have a soccer team, movie studio, TV stations, Singapore post offices. And we don't think these are really important for their core business, which is an online marketplace. So Jack Ma is treating Alibaba like his personal baby, and we're concerned that the share capital could be increasingly misallocated going forward. Now I'll hand over to Zane, who will wrap up and bring everything home for us.
Thanks. So to conclude, really the heart of our thesis is that it takes really heroic assumptions to get to the current share price, much less above the current share price. Let's review what some of those assumptions are. Number one, the Chinese economy grows 8% a year. Oh, and you also have to believe Chinese consumption becomes US levels in just 5 years. And you also have to believe Alibaba is going to capture 15% of all Chinese consumption. Remember, eBay and Amazon, only 2%. Finally, you have to believe that take rates increase substantially from the current levels, and EBITDA margins are above eBay's. If any of these conditions don't happen, the current share price cannot be met. In fact, if you meet all these conditions, you get to 30% below the current share price. Layering on top of that, we've seen the conflicts of interest and the empire building mentality that Carl and Scott talked about. Jack Ma's hand-selected partnership, the Alibaba partnership, has to select a majority of the board members of Alibaba. We also see that there's significant conflicts of interest between Alibaba and Alipay. Jack Ma actually has a higher economic interest in Alipay, and he controls both companies effectively. We've also seen the empire building mentality that we talked about earlier. They're buying soccer teams, movie studios, department stores. It doesn't make any sense. And they're picking up the pace. They're just getting started. That was pre-IPO. I think Jack Ma really said it best when he said in the IPO prospectus, customers first, employees second, shareholders third. You have to ask, where do you want to be in that totem pole? We don't want to be there, so we're short Alipay or Alibaba. We have a target price of $69. That's about 30% downside from the current price. Now I'll open it up for any questions.
Your valuation analysis is completely dependent upon your DCF analysis, correct?
For the most part.
And I think it makes a lot of sense, but this company is trading in the stock market, and it's traded off of multiples. How do you think that your views will actually get translated into a reduction in stock price?
We think
what's going to be the trigger that's going to bring this down?
So I think
the market's discounting is completely. They're not ascribing any value whatsoever to the DCF.
Right. I think that's two problems with the business. One is that people are viewing it as one big entity, which is simply not the case. It's operating assets and financial assets. But the big catalyst we see here is actually we think the IPO of Ant Financial, which is basically Alipay, is going to be a big catalyst to the downside. Because people aren't really thinking about this right now. They see the 37% profit interest in Alipay. It looks awesome. Once you figure out that, yeah, Ant Financial is going to go public, and actually Alibaba is going to have nothing to do with Alipay anymore, that starts to get you thinking that, hey, this isn't actually a great arrangement. By the way, Alipay can jack up its rates if they want and extract a lot of value from Alibaba. I think that's going to be a big negative catalyst, actually, once people wake up to it. And management said they expect to take it public in the next year.
So working off that point, Alibaba consists of 75% of the value that of revenue out of Alibaba is actually transacted through Alipay. So 75% of Alibaba only actually makes up only 25% of Alipay's revenue. So Alibaba is highly dependent on Alipay. Alipay is not highly dependent on Alibaba. So it creates an interesting dynamic, especially coupled with the ownership incentives of extracting value from Alibaba once they go public. To also further answer your question, we actually think monetization of mobile. So as more Chinese consumers use their mobile phone, we can actually start seeing some revenue headwinds. And the reason is because Alibaba makes its money from display advertising, not listing fees. Right? So you can't cram as many good or high quality video ads or advertisements or display fees in such a mobile phone.
What happens if Alipay tries to raise their prices? Do you think there's maybe another option for Alibaba for accepting electronic payments?
It's hard, so first of all, they have to use a Chinese company. They can't use a PayPal because that's a non-PRC entity. So that takes the broad majority of companies out there, the payment networks of the world, off the radar. Is there some Chinese competitor out there that could do it? It's possible. Maybe Jack Ma starts another thing and captures some more value. It's hard to say.
Well, there's actually several other Chinese companies that do this.
Yeah.
Alipay, where do you think they get most of their customers?
Probably from Alibaba right now.
So who needs who more?
But only 75% of the revenue from.
But where do they get their customers?
Initially, they started with Alibaba. Yeah.
Right. So if Alibaba was to cut them off tomorrow, would it be a little harder for them to get customers?
You'll see the interesting same dynamic kind of between eBay and PayPal right now. So in the beginning, you saw PayPal highly depend on eBay and eBay highly depend on PayPal. And that made sense as they were, combined companies. But now as we split off, as we see in eBay, PayPal, you see PayPal pretty much being independent, where a lot of the revenue is actually from what they call marketplaces, where not from marketplaces, from consumer services, where they help small businesses accept credit card payments, well outside of eBay. And so we're seeing that dynamic now, where Alipay is actually starting to include payments not on Alibaba, including vendors and merchants online and offline.
So what's going to happen after eBay spins off PayPal? Do you not think PayPal is going to have to pay eBay for the fact that PayPal is now exclusive on eBay?
I suppose it's a risk, but I don't know who would eBay turn to that it's not PayPal. It's hard to say. Yeah, I don't know. Alipay, yeah. Maybe. I would be long Alipay.
So let me start with the next couple of questions with a premise here. A lot of money managers have a growth mandate. They can't be in cash. They have a growth mandate. They need to invest in growth. And so they have to pick from the existing universe of options. You have a multiple at the beginning. Yeah, that one. Do you know what the estimate for Alibaba's earnings next year is? Fiscal 16, the year that starts in 16.
I actually don't have that, no.
It's $3 a share. So what's their peak?
It'd be 30.
30. What are my alternatives for large cap companies growing revenue more than 40% that have more than 40% EBITDA margins? And yeah, so large cap companies growing top line 40% with more than 40% EBITDA margins. How many companies like that do you think there are?
Probably PayPal would be a great one, eBay.
PayPal's only growing 20%.
Yeah. I don't know how many investment managers have that specific mandate to invest in only 40+%. Yeah, it seems like a niche.
I want to
we agree.
illustrate the thin air Alibaba's in. In general, in the entire universe of investable companies, how many companies do you think there are?
Few.
Yeah, I would agree.
Facebook, and actually the other two are in China, Tencent and Baidu.
Competitors, effectively, or 10 at least.
Right. So Facebook trades at 40 times, Tencent and Baidu trade at close to 30 times.
Yeah.
Is it really ridiculous to think that Alibaba should trade at 30 times?
I think it's part of the misconception of what Alipay means to Alibaba, and I think
Alipay contributes. What percentage of profits does Alipay contribute?
Well, it's considered part of the group right now, so they're not claiming or it's just part of the business. They're not expensing it per se because it's part of the.
It's actually not that, it's not 75%. It's a much, much smaller portion of their profits that's coming from Alipay. It's safe to say less than 10%. And for your scenario, when Alipay goes public, it's not that they get nothing. They get
37%.
7% of how much?
We estimate it's between 50 to 60 billion total value, so 37% of that. But we include that in our valuation. If you look
So
here.
let's go to the valuation. Let's go to the DCF. If you applied this DCF methodology to Facebook, Amazon, Google, the alternatives, what do you think you would get?
Well, with the Google, I think you get a very high value. The core business is very strong, return on invested capital. They have a lot of financial assets at Google, a lot of
If
cash.
you put 5% terminal value 5 years out, pretty sure you would get a lot less than what the stock's trading at now. Certainly for Facebook and Google, and if you think about Amazon, which doesn't generate any cash flow, you get a lot less than that. So why would I prefer those companies over Alibaba? I have to own growth companies. I can't be in cash. I need to own growth companies. Why would I prefer those companies over Alibaba?
For one thing, you have much fewer conflicts of interest, much greater transparency in what's actually happening. You don't have this.
With Google and Facebook?
They have a dual voting structure, at least at Google.
But Zuckerberg and Google and Sergey have as much, if not more, control than Jack Ma has over Alibaba. Those are my alternatives. Jeff Bezos has not. Jeff Bezos, talk about putting investors third.
Good
Those
example.
are your
Yeah.
alternatives. Why would I take those over Alibaba?
I think again the comfort level with you don't see self-dealing of the anywhere near the extent that you're seeing in Alibaba here, where you're making loans, $1 billion loan to one of your management team members to go out and buy a company. And even at Amazon, that doesn't happen. So the conflicts of interest here are huge. All these companies are obviously growing very rapidly. I'd say the future is much more nebulous here. The Alipay thing I think is very big. It's debatable who has more control there, but certainly you could see an outcome here where the Alipay thing does not go well for Alibaba overall.
In that they get a $20 billion check.
That's already in our valuation. And $20 billion is
That's not,
not that many dollars per
when
share.
I say 30 times, that's not really factored in there, because again, Alipay contributes very little to their profitability right now. So at 30 times, when they're trading at 30 times today, that doesn't include anything for Alipay. Or
Yeah.
it includes very little for Alipay.
I mean, I think it goes back to, you look at their EBITDA in 2014, it's 25 billion, let's just assume this number is correct, $900 million valuation, that's 30% below the current share price. I mean, that's 40 times, almost 40 times EV EBITDA for the core business, excluding all this other stuff. I mean, that sounds like it's in line with kind of these other high growth companies. You can argue whether or not those are even overvalued. And the level of transparency and shareholder comfort I would have with owning at eBay or Amazon would be much higher.
Well, how fast is eBay growing?
Might have that here, actually.
Not with PayPal, just eBay.
I'm not sure if we have, I guess I could try to calculate from that, but actually here, eBay Marketplace. 2010, 2011, 2012, 10, 15% a year. So not as fast as Alibaba, sure.
So I think, yeah, Alibaba assumes higher or more aggressive assumptions in the stock, and it's really highly dependent on the Chinese market, where we probably have less visibility and arguably could be less or higher in our sense.
If you look at the, I agree, if you look at a multiple 30 times and it's got strong growth now, but how sustainable is that? I guess you've already directly answered that in that you think that looking at the economic growth and the amount of market share that they already captured, that there are limited growth prospects. So can you address that a little bit more?
I mean, you can see here, the growth that's embedded in our assumptions, if I can find it again. So we're assuming very high growth levels. I mean, you can see here our top line, this is just for the marketplaces. If I can find it. That's a very high level for the foreseeable future. And again, these are using very generous assumptions. So if I go back to the revenue buildup, I think it's extremely unlikely that consumption of GDP goes from Chinese levels, 35% to 68% in just 5 years. So this,
How long do you think Facebook can grow more than 30%?
not long. 4 or 5 years.
Right. And so this is just China.
Right.
What about Russia? What about Brazil?
Yeah. What you've seen with this company, though, they've tried to expand internationally, and I don't think it's going as well as they perhaps like to parrot. One of the things we don't have really great insight into, unfortunately, with this company, because they don't disclose a lot, kind of like Amazon, is how each of these businesses are doing on a margin basis. So they have like cloud computing, somewhere up there, international commerce, and it's growing, but it's not like doubling every year, and it's starting from a very low base, by the way. Who knows how profitable those things are? We have no idea. But that's a story that I like to spend a lot, that we're going to go to United States, we're going to go to Russia. I'm sure they'll have some success in some markets, but are they going to come in and just get rid of eBay or Amazon in the United States? I don't think so. Could there be an Indian competitor that does the same thing in India pretty quickly? Probably.
They're spending money on movie stations and soccer teams. So
let's talk about that for a second.
Yeah.
What if my stated strategy was what I would refer to as a multi-screen strategy? A strategy that says, yeah, people are shopping on the computer now and it's kind of shifting to a phone, but I'm pretty sure I have the technology for people to shop on their TV with their remote. What would I need to own? I have that technology.
You could argue maybe a movie, TV or
Content.
post office, soccer team. I don't know. There's all sorts of things you could buy that would help that.
Content.
Yeah.
And what if there was my top competitor, JD, was really good at the 3 C's, right? Computers and electronics. And there was one particular vendor of computer equipment that had a great distribution network. And not only do they have the product, but they get their electronics very quickly to consumers, which is my most glaring shortfall versus my competitor. Would that be really a zoo to buy them?
So how capital intensive is this business that you're going to start? You start buying up all these businesses. Do you earn a 350% ROIC anymore? I mean, it's very debatable. This business is priced such that it's going to be a marketplace model, which is generally great businesses. You start expanding into department stores, these asset intense businesses, ROIC goes down. You can revise the model then and see what it gets you to. Capital intensity comes much higher. I would be very concerned that they're spending so much money on all these different businesses. You've seen Amazon do it. Granted, their share price is up very high. Do they have the profits to back it up to say that they've actually successfully executed this strategy? Has capital intensive increased?
In light of those strategies, is it more crazy to buy a movie studio and a home appliance manufacturer or a company that makes virtual reality goggles?
Yes. I don't know. All of the above are crazy.
We can agree on the ridiculousness of Oculus.
So it's in the land of the blind, the one-eyed man is king, right? That's the point.
Yeah. And so, there are some events. Some of the, just toggling back, we don't think obviously every investment's something that terrible. So the investment in Hair and Meizu, these are phone and consumer electronic manufacturers. Some of that stuff makes sense. And we're like, okay, we can kind of see with your one screen kind of policy, okay, that fits in the world of getting in front of consumers' eyes. We're going to do everything that's necessary to do that. But then when we're researching, we realize like a soccer team or a Singapore post office, it's like, okay, maybe 2 or 3 derivatives down the line, that would make sense. But
Singapore Post Office is actually an e-commerce company in Singapore.
Oh.
But the soccer team you have.
Yeah.
I cannot for the life of me explain the soccer team.
It's cool. It's one of those things where it's like, oh, that's a really strong investment. We actually understand that. And then another time you're like, what are you doing?
And I think that's what concerns us is they did all that before they even went public. Let's see if I can find the list here. Probably can't read it all, but these are all the acquisitions they made of any materiality in the past few years. They did all that before they were public, and now they have this huge, momentum behind them with the IPO. What's next? They did $1 billion in January alone. I'm worried. These guys don't make that much per year in free cash flow.
And to circle it back, I think it's the and statement. When we kept looking at this company, we're like, should it be long or short? It was the and. It has to be this and that. And so it's like China's growing and increasing consumer consumption by Chinese consumers. So going from 34 to 68. And you have to realize the US is 68, it's the outlier. UK is in the low 60s, and some of Western Europe is in the 40s and 50s. And you need, Baba must capture more of it, and they have to increase their take rate by more than 2x.
What's e-commerce look like?
So if you go, can you go to the sensitivity table?
Sure.
If you,
Which one would you like?
with the EBITDA margin and take rate, right there,
Yeah.
yeah, right there. So clearly, the risk to your thesis is that take rates increase. Tell us or show us your analysis of why you don't believe take rates will increase significantly.
Sure. So one important fact about the factoring on take rate is how they make their money. So one of the things I discussed was Alibaba makes their money from display advertising and only display advertising. When you try to maybe compare it with an eBay, well, eBay makes money off of advertising and from listing fees that it charges the seller. Now you say, okay, well, why can't Alibaba do that? Well, as I was saying, you can kind of see the lever in the sense that if I start charging more fees and listing fees, I'm going to see gross market value go down. I'm going to see my GMV go down. And that affects take rate. So for me, the highest one's like, well, going from 2 to 4, we think is really hard because they have a very actually different model than eBay in terms of how they actually make their money.
It's also, unfortunately, we don't have the slide in here, but there's been a big shift towards away from desktop purchases towards mobile. And like Twitter or many other things you see, ad rates for mobile are generally lower. The experience is not as good. Advertisers are just not willing to pay as much money for that. And as that mix shifts, you see that, if I remember right, the take rate for a mobile transaction is like 1/5 or 1/6 the rate of desktop. So I think GMV is going to continue growing significantly overall. Take rate may move up a little as they kind of tweak things and improve things. Yeah, absolutely. But you also have this huge headwind of mobile, and you have to basically get to 2x or more of the current take rate to get to any type of attractive valuation. And that's assuming everything else, whether it's consumer consumption, market share, et cetera, assuming all that comes to fruition, which, like Ron said, that's very aggressive.
About 2.5 minutes left for any last questions.
So you want us to short e-commerce and short China? In a market where, harping on his point, companies like this don't come around every day.
Yeah.
And I gotta buy, to Sarah's point at lunch, I gotta be fully invested.
Right.
So this thing better be the slowest gazelle in a pretty fast herd. Just from a 1-year portfolio manager time frame for me to go, all right, we're shorting it.
So we'll take the opposite side. So when we finally finished our analysis, we said, okay, what happens if we wanted to be long this? What would we have to be comfortable with? And when we, again, went back through our 4 scenarios or 4 and statements, it's like, could we believe all 4 of these things without one of them being faulty, to be able to say with conviction and with a margin of safety that, yes, I would invest long in Alibaba? And the answer was no.
But in 12 months, we're not gonna know that China GDP is 8, not 9.
Even if it's 9, it doesn't move our valuation needle enough. But what I'd say, the company I would like to own a lot is Alipay. I think that's a great business. I think the core business here is very good. But what you're going to see is, in my opinion, when the split finally happens, Alipay is going to do very well, and this thing is going to, I don't want to say collapse, but it's not going to be a good performance. And the relative performance, if I were ever to do a pair trade, that would probably be the pair I would do once the shoe drops.
But you think the sentiment will change?
Absolutely.
And the price will drop. It'll be the listing of the financial, which will be the trigger?
I think when people realize how much value, what percent of the value at what was formerly this whole Alibaba entity was captured by Alipay, once you get clarity of that, frankly, once the S1 comes out for that, I think people are going to start taking a very good look at Alibaba and say, it's not quite what we thought it was. Maybe that's the one I want to own.
So maybe I misspoke earlier. So 75% of GMV on Alibaba runs through Alipay. Right? So there's a great dependence there. And so when you start seeing this separation, and you're seeing that with PayPal and eBay, you're going to start seeing a lot more uncertainty with the marketplaces and a lot more comfortability with the high growth, high revenue for Alibaba, Alipay, or in our case, PayPal.
What happened when eBay announced they're spinning PayPal off?
Good question. You don't know.
Yeah, I don't know the answer.
Yeah.
Stock went up 20%.
Nice. Different business, though. Do you have the conflicts of interest inherent Alipay and eBay, or Alipay and Alibaba?
I think from a shareholder, it's the same business, right? You're sitting here going, I don't know what it is, but spin-offs are usually good. And from a momentum standpoint, that sounds like great news. So
Usually when a spinoff happens, I guess I think about it this way too. A lot of spinoffs you see, it's the sexy new business that gets spun off and the dying old business or less attractive business that comes out. And the problem is, which one do you generally want to own? Which one's the hot one?
What's the historical performance in that situation?
I couldn't quote your stats, sorry, but
The stub usually does a lot better.
spin-offs win. If you guys take one thing out from a shareholder, spin-offs win.
on a net basis,
A
right?
managed spin-off is a very attractive thing from a shareholder standpoint. And these guys are talking about spinning off a business that you just told me you want to own.
Right. So you want to own
So-
the,
Why doesn't that cause Alibaba's share price to go up?
because people are still treating it as if it's going to have a remaining equity interest in that piece. But the reality is, once that split happens, and Alipay can start charging whatever it wants on the Alibaba platform, that's not a good scenario.
So yeah, so like,
And you probably know the answer to this, but I'm curious what the contractual agreement is between eBay and PayPal. I'm guessing they signed probably a long-term arrangement for, you know,
Well, the negotiating, it's a big point of contention.
sure, and you can see why.
The point of these spins, not only does the spin itself create value, like in almost every instance, but what ends up happening is investors flock to the sexy company that gets spun off, which means the valuation of the stub is usually really low at the point of spin-off.
Yeah.
Historically, stubs have significantly outperformed the company that was spun off, precisely because of that, because everybody's so eager to own the piece that gets spun off that the stubs actually end up being the better value.
My experience too, though, with spin-off is you don't often, eBay and PayPal, obvious exception, you don't often have this reflexivity. Usually it's two separate business units, or for some reason combined a conglomerate, one gets spun off.
and one real quick with eBay and PayPal, like eBay will still hold ownership in eBay in PayPal. They'll still get to capture some upside.